Okay, so here's an example of the S&P 500 reversing in the last few weeks from what has been a very strong uptrend. Certainly the US equity markets have been the strongest in the Western equity world. A few weeks ago, we did get one of the last DeMark exhaustion signals, and that is exhibited by the red number 13 there, which appeared just at the peak, the actual major peak, most recent major peak on the S&P 500. Now we did have an exhaustion signal before then, where the market kind of bypassed and continued to move higher. But the very last signal that I'm showing you there, just as we developed that triple, that kind of minor triple top pattern, the market did reverse sharply and is currently within that rollover mode. Can everyone just see that? I'm not sure. Can anyone see the mouse on the chart? I'm just wondering if I can just quickly draw something here. So the signal basically appeared around this point here. Can everyone see that on the chart? Yes. Can you all see the annotation that the circle that I just highlighted on the chart? Great. Okay. So that's when the signal appeared. We also had a signal appear around around this area here. The market continued higher because it was still strong, just like you get an overbought signal. The market remains overbought and it continues to move higher. And then finally, this signal here really was quite strong, quite potent. And we had the triple top 1, 2, 3. After then we got the reversal. Now, one point I'll make here. So this is a key signal to keep in mind. One of the ways that you can use DeMark's indicators is, of course, in addition to all your classic analysis. So your classic analysis may be telling you that there's a classic head and shoulders pattern here, as Wojciech just said. And so that would then have given you a lead signal to this pattern taking place. And as a target, of course, you would want, we've already broken below the neckline, but you would maybe want to break below these swing lows. But furthermore, this 1250 level is quite important because it's very near 1250, 1248. It's very close to the 200-day moving average and the 50% retracement. So it would be quite an important level for the market to be magnetized to on the downside. So I'm giving you kind of a very important DeMark signal, sequential DeMark signal that appeared in the market just a few weeks ago on the S&P 500. It was very important in actually telling you not only that the S&P was about to reverse because it was so exhausted, but also the rest of the US equity market, European market, and general risk appetite portfolios, risk-centric portfolios, which were starting to unwind during this seasonally weak environment. Remember the turn of phrase, sell in May and go away, where volatility tends to increase. So this was not just the S&P 500, this was a lot more than that. This was signaling the domino effect in the market. And good question. Which time frame is this on? This is on the daily chart. Keep in mind that you can use DeMark indicators across all time frames, intraday time frames, from minute charts to 5-minute charts to 15-minute charts, all the way up to daily, weekly, monthly charts as well. So this is a daily chart. One of the best ways to use DeMark indicators, as you would do with any other type of analysis, is to use it across multiple time frames to increase the probability of that signal taking place. Okay, so in this example, I just showed you the most important signal on the US equity market, the S&P 500, which was triggered a few weeks ago, the DeMark TD Sequential indicator, signaling exhaustion with the red 13, which is the signal itself, just at the market top. And for classic market observers, you can see that it also then developed into a pattern, a reversal pattern, otherwise known as a head and shoulders reversal pattern, which we have punched below. And one of my key targets on the downside is around 1250, which is roughly where the 200-day moving average is, and the 50% retracement zone, which basically would symbolize where the market would have lost half of what it made since the bull rally began in September of last year. Is everyone okay with that? S&P 500? Yeah. If I just get a few yeses just so I can move on to the methodology of how DeMark's indicators are actually developed. Okay, great. So that's part one. We've spoken about Tom DeMark, the modern market wizard, and just a little bit about how you can access indicators and the 40 years worth of development research that was put into his indicators. And I spent quite a bit of time talking about the true nature of trends, understanding the concept of speed, the subtleties of what speed can tell us about market exhaustion and market reversals. And then we've just kind of spoke throughout that about the idea of market timing being everything, especially in volatile markets, because volatile markets tend to produce a lot of price swings. And so any market timing indicator or analysis does give you an edge, especially in volatile markets, in terms of entering a trade opportunity and also, keep in mind, exiting a trading opportunity. Okay, so part two, we're actually going to talk about the TD Sequential model. What are the key stages? Remember I said the key stages are TD setup and TD countdown. The only two stages that you need to remember within the sequential model. And then I'm just going to mention just a few points as to basic points as to how to successfully trade the 9 and 13 signals. Keep in mind this is just a basic seminar. I just want to familiarize everyone to the TD Sequential indicator developed by Tom DeMark. And in future webinars, then I can do intermediate and advanced sessions. But for now, I just want to keep it light. I just want to keep it simple and focused. Now, there's a question from Mike Chandler. As frequently as you see range-bound trading, have you found the value of TD range, particularly long-term frames? I would say yes, very much. And I'll quickly show you how you can use TD Sequential in range-bound market. One example I will show you is euro-dollar. Another question from an attendee, Boyke. By the way, 15-minute remain as someone. 15-minute remains as someone else. Yeah. Okay. So we're running out of time, so I'll just quickly speed along. Okay. So this is a theoretical kind of illustration of the TD Sequential model. It can take many different forms, but this is just my very simplistic theoretical illustration of how the TD Sequential model develops in the market. And it is quite dynamic. Now, remember I said it's a two-stage process, TD setup, TD countdown, and these stages are color-coded. TD setup is color-coded in green, TD countdown is color-coded in red. But to actually initiate both of these stages, you must have what we call a TD price flip. And that's the initiation stage of this sequential model. Is everyone okay with that? So it's a two-stage process, TD setup, TD countdown. The first stage, TD setup, is color-coded in green. The second stage, TD countdown, is color-coded in red. But to actually trigger or activate this process, we must have a price flip. Now, in front of each of these stages, the letters TD, of course, are, as you may have guessed, after the creator of these indicators, Tom DeMark. So everything is patented TD. So TD price flip, the initiation stage, TD setup, stage 1, and TD countdown, the last stage, the second and the last stage. Now, the numbers are critical. First stage, the TD setup, you will know that stage has been completed when you get the number red appear. And the last stage, the TD countdown, you will know when that stage and the grand signal itself, the final signal itself of the entire sequential process, you'll know when that signal has been activated by the number 13. Now, a lot of people ask why 9, why 13? Now, this is down to DeMark's research that he had done over the last 40 years. And when he was developing the sequential model, he originally started using Fibonacci numbers because he believed in the mathematical and natural properties of Fibonacci numbers. But when backtesting these numbers in his own kind of manual empirical research, he preferred to use 9 as opposed to 8 from the Fibonacci sequence. And so we have 9 as a completion of the setup sequence, and 13 as the completion of the countdown sequence, and 13 is, of course, the Fibonacci number. But try not to focus too much on the numbers, because essentially this model is, in my opinion, so good and robust in what it does, in terms of how it's calculated, in terms of how it measures market exhaustion, that the numbers aren't as important as you might think they are. Of course, they are the successful back-tested results of Tom DeMark's work, but try not to focus too much on the numbers, because it is actually the methodology behind the numbers more than the numbers themselves.